Good morning, all of you. Today's topic is theory of interest. Shall we start the class? This particular topic is coming under Block 5, Unit 19. In this topic, we are going to discuss about what we mean by interest and liquidity preference theory. In that, there are three different demand: transaction demand, precautionary demand, and speculative demand, and how this theory has been criticized. These are the things we are going to discuss today. The main objective of this particular topic is to understand the implication of the interest theory. Let us get into the class. According to John Maynard Keynes, the interest is not a reward for saving as been postulated by the classical economists, but the reward for parting the liquidity of a specific period. It is purely a monetary phenomenon and is determined by demand for and supply of the money. So both sides are there. It is basically depends on demand for money and supply of money. The supply of money refers to the quantity of money in circulation at the fixed point of time. Since it is controlled by the central bank of the country, it remains constant in the particular period. So in order to see how the rate of interest is determined, it is necessary to consider the demand for the money also. The demand for money does not refer to savings or money required for spending on goods and services, but the demand is actually a stock of money to hold as a liquid balance. The classical economists believed that money was only held for the purpose of making a transaction and bridging the time period between the income receipts. But Keynes added a possibility of a demand for money in a different way, like precautionary balance and speculative balance. Let me start the liquidity preference theory. There are three motives for demand for money which are identified based on the transaction made. The first one is transaction demand. Second one is precautionary demand. Third one is speculative demand. Let us start with the transaction demand. Transaction balance are needed to bridge the time gap between the income receipts and the expenditure. The amount of money demanded for transaction purpose depends on either the length of time between the income receipts and expenditure is there, or the size of income receipt and the expenditure. The transaction balance would vary directly with the income and price level and not the rates of interest. If national income rises, people will require more money for spending purpose. Similarly, if the price level rises, the people will require more money to buy the same amount of goods and services. So the transaction demand does not have any influence through the interest rate. But there are two more motives which demand the interest rate. What are they? First one is the precautionary demand. The second motive in the liquidity preference theory. Money is also held for the purpose of meeting the unforeseen emergencies. This motive was not included in the classical theory, where it is perfectly certain, it is not assumed. Keynes grouped the transaction and precautionary balance together and a single sum which varied directly with the level of income and general price level. So people will not only keep money for transaction purpose, but also for the precautionary purpose. This induces the interest rate. The third motive is speculative demand. The speculative motive was the first identified by John Maynard Keynes. This is also known as asset motive. In order to understand this concept, it is necessary to ask the transformation and speculative balance. Why should people hold money over and above when the money is an asset which yields no return at all, but still they will keep? Why? Because the other two reasons, precautionary motive and speculative motive. That is one question, why people are keeping money. The answer for this question is that the other financial assets, particularly bonds or other assets, it's likely to fall price. Then there is a possibility of loss in the bonds, which can be avoided by holding the money. So people will keep money in their hand, not only for transaction purpose, but also for the precautionary purpose and speculative purpose. The basic motive for holding speculative money balances was therefore to avoid losses in the declining security market. In order to understand this point more clearly, it is necessary to consider the relationship between the bond prices and the rate of interest. In this particular context, the Keynes was referred to undated government securities. We used to call it as gilts, G-I-L-T-S, gilts. These bonds pay a fixed annual sum and are bought and sold on the securities market. Their prices therefore vary with the demand and supply. For example, if your undated security has a nominal value of rupees 200 and pays rupees 10 per annum, the nominal interest coupon is, say, it is 5%. So this is a basic idea. This is found out by the following formula. How we can get that particular value of interest? Price of the bond equal to fixed annual return divided by prevailing market rate of interest. That is rupees 10 by 5%, which is equal to 10 by 1 by 20 equal to rupees 200. However, the actual yield or earning of the yield expressed as a rate of interest will vary inversely with the market price of the security. As we can see in the following example, it can be seen that the market price of the bond rises to rupees 400 and the fixed annual payment is rupees 10, represent the equal earnings of earned by 2.5% of rate of interest. And when the price of the bond falls rupees 100, the rate of interest rises to 10%. Thus, the rate of interest is a reciprocal of bond price. And the market price of and rate of interest, that is earning yield or fixed interest of the bond, therefore inversely related. You can see this particular table. There are 4 columns. First one is nominal price. Second one is rupees 10 annual payment. And third one is market price and earning yield, that is rate of interest. The nominal price is same, 200. The annual payment is 5%. When the market price increases to 400, then it is the rate of interest will be 2.5%. Suppose the market price is decreased to 100, then from 5% it increased to 10%. So with this simple example, he have made this liquidity preference theory in a 3 basic category: transaction motive, precautionary motive, and speculative motive. Keynes was the first economist to point out that it costs money to hold the money, and the rate of interest is the opportunity cost of the money holding. That is, by holding the money, people lost the opportunity earned interest. So at the low rate of interest, people hold as much money as possible, and high interest lesser the money possible. The speculative money balance vary, therefore, with the anticipated gains or losses on the securities market, and the extent to which the individual prefer to holding the money to the other financial assets, it is referred as liquidity preference. Keep it in mind that the relationship between the security prices and the interest rates can be in a different way. So these assumption is Keynes has made. The first assumption is when security prices are high, the interest rates will be very low. The speculator will expect to bond prices to fall, and therefore a capital loss to be made. They will therefore attempt to avoid such losses by holding the speculative money balances. Low interest rate therefore imply a high liquidity preference. In this case, the opportunity cost holding money is very low. What is the other, we can put in another way, when bond prices are low, what will happen? The interest rate, therefore, it is a high. So the speculator will anticipate the rise in bond prices, and therefore he will concentrate on capital gain. They will attempt to take advantage of that particular capital gain on bonds by holding the bonds rather than the money balances. The high interest rate therefore imply a low liquidity preference. In this case, the opportunity cost of holding money is high. If each individual liquidity preference is added together, the liquidity preference curve can be drawn, because aggregation of a single will become the nation, which represents it's nothing but the demand for money curve. The liquidity preference curve relates to the total demand for money to the interest rate. Although each individual may have a different expectation of the future event, by adding them all together, we obtain a smooth liquidity preference curve as shown in the figure. You can see. In the vertical axis, rate of interest is measured. In the horizontal axis, money balance is measured. When we aggregate the individual liquidity of money and join together, a smooth downward sloping curve from left to right. The total demand curve for money is a downward sloping due to speculating components. Much varies inversely with the rate of interest. When the interest rate is high, say R1, the bond prices will be low. On rise in the bond price, therefore, there will be a capital gain, which will be anticipated, and speculative balance will vary with a very small, almost equal to zero. Why? Because the interest is low. So only the transaction and precautionary balance hold at MD1. When the rate of interest is low, say in case of R2, the bond prices are high, capital losses are anticipated, and large speculative money balances will be held. Why? MD2, in order to avoid the capital loss, or because the interest is very high, so they will not keep more money with them, they will invest in order to get the capital gain. Now, let us move to the supply of money. The supply of money at any point of time is fixed by monetary authorities, normally the central bank of the country, and therefore it is independent rate of interest. You can see the next figure, figure 5, the money supply with the line MS. The money balance is measured in the horizontal axis, and the rate of interest measured in the vertical axis. MS is the supply curve. So, irrespective of change in interest from R0 to R1 or R0 to R2, the money supply will be the same. So, how to get the money market equilibrium and how interest rate is determined? The money market reaches the money balance equilibrium when downward sloping demand curve of money intersect the vertical supply curve at the rate of interest determined by RO. You can see the diagram. RO at that point E, it is intersecting. It is a downward sloping curve from left to right, the demand curve, and a vertical curve is a supply curve. The demand curve intersect at the point E. We may say it is RO. What is the logic of this particular equilibrium? If the rate of interest goes above the equilibrium level, say R1, there will be a excess money supply. Say AB is a money supply, which implies the excess demand for the bond. Because Keynes' model of money holding says the alternative use of that particular money for the bond holding. If the demand for the bond increases, its price will rise. This is equivalent to the fall in the interest rate. In this case, it is RO. But on the other hand, if the rate of interest falls to R2, there will be an excess demand for the money measured in the distance. Here, the demand is less, the supply is more. This implies the excess supply of bond. People will meet the demand for money by selling the bond. As a result, the price of the bond will fall. This is equivalent to the rise of rate of interest. So, RO is indeed the equilibrium rate of interest. Any deviation from this particular RO, either it may be R1 or R2, definitely there will be a change in the interest rate. This is explained this particular theory, liquidity preference theory. This theory believed by many people, and for a longer time it has been implemented. But few economists have criticized this. Why? There are unrealistic assumptions are made. Some of the criticisms are, this particular theory believes the change in interest rate could occur because of these reasons. A shift in the liquidity preference theory from MD4 to MD1 shown in the previous figure result anticipated change in the bond price. But actually, whether it will happen or not is subject to the discussion. Why? Because people will not change frequently. A shift in money supply curve from MSO to MS1 because of the change in policy of central bank. If the central bank increases the quantity of money in the circulation, then the supply curve will shift to the right and the rate of interest will fall. On converse, it is true. According to modern economists, the changes in either of the quantity of money or the liquidity preference can no doubt bring about the changes in the interest rate. But the outcome of such changes is not always certain. Why? Because people will not change instantly. New developments may only cause wide difference in the opinion, leading to increasing activity in the bond market without necessarily causing any shift in the aggregate speculative demand for the money schedule. So when the central bank is changing its policy either to increase the money supply or restrict the money supply, immediate effect cannot be expected, but it will be reflected in the interest rate. If the balance of market expectation is changed, there will be a shift in the schedule. The central bank policy decide to increase the money supply may therefore be met by the upward shift in the speculative demand function, leaving the rate of interest virtually, it is unaffected. So, because of change in policy, this particular liquidity preference will hold good. Because central bank has to take some initiative, either monetary measure or non-monetary measure. The key factor is the interest rate. With this, let us move to the criticism of this particular theory. Many economists have criticized this particular theory. The first criticism they made as its ambiguity. Keynes does not explain clearly what we mean by money. Owing the vagueness, it has said the Keynesian theory is indeterminate. Keynes ignored the real factors like productivity of capital and thriftness as determining the interest rate. In the words of Hansen, H. Hansen, he put in this way. In the Keynesian case of supply and demand for money schedules, cannot give the rate of interest unless we already know the income level. In the classical case, the demand and supply schedules for savings offer no solution until the income is known. Precisely, the same is true for a loanable fund theory. Might be this theory holds for the loanable funds and not for the actual assets. The Keynes criticism of classical and loanable funds theories applies equally to its own theory. He have criticized the classical theory and loanable fund, but the same defect is also there in the liquidity preference. In the words of Hansen, we can understand that. The second criticism was the Keynes dismisses as irrelevant to the marginal productivity of capital. According to him, new investments are determined by the psychology of the entrepreneur and the current rate of interest. But since the entrepreneurial activity is based on the productivity of capital, it seems hardly proper. They ignore the other things. If they have money, they will do the business. If they don't have money, it is not possible to initiate the business. And third criticism is no role assigned for the savings and waiting. The Keynes ignores the inducement of savings and waiting. Jacob Wiener, economists have made a very clear statement: without saving, there can't be any liquidity to surrender. According to Keynes, interest is a reward for the parting of the liquidity and no way an inducement of savings. But it is ridiculous to think the surrounding of the liquidity if one has already saved the money. So this criticism is more important for this particular liquidity preference theory. And one more criticism is this theory as a biased view. Why? Keynes places undue emphasis on monetary phenomena. The Somers, the another economist, points out that an individual having a fund has 4 choices before him: to invest on securities, to hold cash, to invest in the production, or to consume. These are the 4 purposes. The commercial firm has the first 3 choices and not the 4th one. The decision of the individual and the firm regarding to these choices of each area may influence the rate of interest. The choice of regarding investment in the securities is determined by the demand and supply of securities. The choice regarding the holding of cash is determined by liquidity preference. The choice of recording the investment in the production is determined by marginal productivity of capital, but Keynes have ignored that. The choice of recording the consumption is determined with a time preference also. Hence, we must say the demand and supply of securities, of course, the liquidity preference, the marginal productivity, and the time preferences all play their part in determining the rate of interest. However, Keynes takes only account of the liquidity preference related to the rate of interest. The supply of money has been ignored. And of course, the time factor is ignored. So this particular theory has been criticized in many ways. One more criticism is more important one, the partial equilibrium approach. Professor Somers rightly pointed out, the interest rate is affected by all other prices and economic quantities of the community. In his words, all the elements expressed in the equation of Walras and Hicks system in general equilibrium, but people are more insist only the general equilibrium, but there is a possibility of partial equilibrium approach that holds good because that is a reality. Hence, both the loanable funds theory and the liquidity preference theory represents a partial equilibrium analysis